The Pakistani Rupee has been on a tumultuous ride in recent times. As of February 4, 2025, the Rupee closed at 278.96 against the US dollar in the interbank market. This marked a slight appreciation from the previous day. However, the open market told a different story. The buying and selling rates for the Rupee hovered around 278.95 and 279.45 per US dollar respectively. These figures highlight the volatility that has become a hallmark of the Pakistani Rupee's exchange rate. The Rupee's value has been influenced by a confluence of domestic and international factors. Global economic trends, particularly the strengthening of the US dollar, have played a significant role in shaping the Rupee's trajectory. Understanding these external pressures is crucial for comprehending the forces at play in Pakistan's foreign exchange market. The interplay between the US dollar's strength and the Pakistani Rupee's vulnerability reflects the broader dynamics of the global economy. The US dollar has been on an upward trajectory, asserting its dominance in the global currency market. This surge in the dollar's value has sent ripples across the global financial landscape, impacting currencies from Asia to Latin America. Several factors contribute to the dollar's strength. The US economy remains resilient with robust growth indicators. This economic strength makes the US dollar a safe haven for investors seeking stability. The Federal Reserve's monetary policies, including interest rate hikes, have also played a role in attracting foreign capital to US shores, further bolstering the dollar. As the US dollar continues its ascent, other currencies are feeling the pressure. Emerging market currencies in particular are facing the brunt of the dollar's strength. This phenomenon is evident in the weakening of currencies like the Pakistani Rupee, the Turkish lira, and the Argentine peso. The global trade environment has become increasingly fraught with tensions, sparking currency wars that exacerbate existing vulnerabilities. The US-China trade war in particular has cast a long shadow over global markets, injecting uncertainty and volatility into currency exchanges. The imposition of tariffs and retaliatory measures has disrupted trade flows, impacting the relative values of currencies. When trade tensions escalate, businesses and investors become wary, leading to a flight to safe haven assets like the US dollar. This capital flight puts downward pressure on the currencies of countries caught in the crossfire of trade disputes. The trade war's ramifications extend beyond the US and China, ensnaring other economies in its web of consequences. Countries deeply integrated into global supply chains like Mexico and Canada have felt the tremors of uncertainty. Their currencies have experienced fluctuations as businesses grapple with the ripple effects of disrupted trade relationships. The Chinese yuan, a key player in the global currency arena, has found itself navigating a precarious tightrope amid escalating trade tensions with the United States. The yuan's value has been under pressure, reflecting the challenges posed by the trade war. Chinese authorities face the delicate task of managing the yuan's exchange rate to mitigate the economic impact of tariffs and maintain stability in their financial system. A sharp depreciation of the yuan could trigger capital flight and undermine confidence in the Chinese economy. However, a weaker yuan can also make Chinese exports more competitive, providing a buffer against the effects of US tariffs. Balancing these competing forces has become a priority for Chinese policymakers as they navigate the complexities of the trade war and its impact on the yuan. Section 5 North American currencies feel the heat. The trade war's impact extends beyond Asia, with North American currencies like the Canadian dollar and the Mexican peso feeling the heat of uncertainty and retaliatory tariffs. The Canadian dollar, often referred to as the loonie, has weakened against the US dollar as investors weigh the potential consequences of trade disputes on the Canadian economy. Canada's close economic ties with the United States make it particularly vulnerable to disruptions in trade relations. The Mexican peso has also faced downward pressure, reflecting concerns about the impact of tariffs on Mexican businesses that rely heavily on exports to the US market. The interconnectedness of North American economies highlights the ripple effects of trade tensions. When one country's currency weakens, it can impact the competitiveness of its neighbors, potentially leading to a cascade of economic consequences. Section 6. Oil markets react to currency swings. The currency market's gyrations have sent ripples through the global oil market, influencing the price of this crucial commodity. Oil, priced in US dollars, becomes more expensive for countries with weakening currencies, affecting energy costs for businesses and consumers alike. When the US dollar strengthens, oil-producing countries may adjust their production levels to maintain revenue streams, potentially impacting global supply and demand dynamics. These adjustments can lead to price fluctuations in the oil market, creating uncertainty for energy-dependent industries and consumers. The interplay between currency movements and oil prices underscores the interconnectedness of global commodity markets. Understanding these relationships is crucial for businesses operating in energy-intensive sectors, as well as for policymakers tasked with ensuring energy security. Section 7. The interconnected global economy. The intricate dance of currencies, trade wars, and commodity prices highlights the interconnected nature of the global economy. Events in one part of the world can quickly reverberate across borders, impacting businesses, investors, and consumers far beyond the epicenter. The strengthening US dollar, fueled by a robust US economy and trade tensions, has sent shockwaves through global currency markets. Currencies like the Pakistani Rupee, the Chinese yuan, the Canadian dollar, and the Mexican peso have all experienced volatility in response to these global forces. This interconnectedness underscores the importance of understanding global economic trends and their potential impact on local markets. The currency market's fluctuations serve as a reminder that events in distant corners of the world can have a profound impact on our daily lives. Section 8. Navigating currency volatility, a guide for businesses. In this era of heightened currency volatility, businesses operating in the global marketplace must navigate a complex and rapidly changing landscape. Managing currency risk is paramount for companies engaged in international trade, as fluctuations in exchange rates can erode profit margins and impact competitiveness. Hedging strategies, such as forward contracts and currency options, can help businesses mitigate their exposure to currency risk. These financial instruments allow companies to lock in exchange rates, providing greater certainty in their financial planning and reducing the impact of currency fluctuations on their bottom line. Beyond hedging, businesses can adopt other strategies to navigate currency volatility. Diversifying their supplier and customer base across multiple countries can reduce their reliance on any single currency. Additionally, businesses can explore opportunities to invoice in their own currency, shifting the burden of currency risk to their trading partners. Section 9. The importance of informed policy making. Policymakers play a crucial role in navigating the challenges posed by currency fluctuations and global economic uncertainty. Central banks, for instance, can adjust interest rates and intervene in currency markets to stabilize their own currencies and mitigate the impact of external shocks. Governments can implement policies that promote economic diversification, reducing their country's reliance on a single export market or trading partner. This diversification can provide a buffer against the negative consequences of trade wars and currency fluctuations. International cooperation is also essential in addressing the root causes of currency volatility and promoting global financial stability. By working together, countries can foster a more predictable and resilient global economic system that benefits all.